Hello, Childfree family and friends. Cody here. Welcome to episode 12, Investing 101 in our Childfree Finances chat. I'm Cody Hutzel, the founder for Childfree Family, and I'm one of the co-founders for the Childfree Convention coming up in June 30th and 31st, 2022. I'm repping the old 2021 shirt, which is now retired. If you happen to get one of these bad boys, you have something to brag about because they're not available any longer. We retired it to release the new gear. And anyway, I'm also involved in a lot of other child-free type of conversations that happen all around the lifestyle sphere of child-freeness. So I'm happy to be a part of that. And I'm happy today to have my buddy, Dr. Jay, joining us. Dr. Jay Zigman is child-free. His wife is also child-free. They're a child-free couple. He has a PhD in adult learning from the University of Connecticut. He is a certified financial planner. And a key thing to note about Dr. J is that he is a fiduciary, which means he must put the needs and interests of his clients above his own. He is an advice-only and fee-only certified financial planner. So in other words, he's paid for his time by his clients. He doesn't get kickbacks and incentives and commissions from offering products, which is always a nice thing whenever you have someone working with your finances, which we're about to learn about in depth here in a moment. So they pay him for his time and he helps them learn to manage their own finances. Dr. J, thank you for joining us once again today. How you doing?
Good. I was hoping, maybe one of those shirts would magically show up here, but I guess I have missed the train on those.
we tried to talk about it during the last convention live stream that we were going to retire them at the end of April, and we did. So yeah, they're a collector's item now, but we didn't number them or sign them or anything, but we know there's only so many floating out there. But anyway, just a reminder before we get too far in this, our good old disclaimer: the following views, thoughts, and opinions expressed are for entertainment and educational purposes only. Please seek the assistance of a professional to aid in your financial decisions, especially about Investing 101. So we'll jump right in. Where do folks start?
Yeah, and I just need to reiterate that disclaimer. I'll tell you about how to do it, but I'm not giving you any advice on what to invest in or anything like that.
You don't have a hot stock tip to tell everybody about?
So I swear, every time on Facebook somebody posts, tell me what to invest in. And I'm like,
Don't ask Facebook what to invest in, first off.
So, okay, we are both, I don't know, got a few years. And I was writing this, I'm like, should I talk about orange commodities? Orange juice, remember the movie? We're talking about the orange juice.
Trading places.
See?
Yeah, Mortimer.
Yeah, it's getting crazy. So anyway, where to start? So everybody kind of goes, what do I do? Where do I go? What do I, and it's overwhelming. I mean, let's be real. If you Google on the internet how to invest, what you get is a whole bunch of stuff. I'll be polite on that. A whole bunch of garbage, and everybody wants you to invest in their stuff.
Well, a lot of talking heads that say, hey, if you'll pay me to learn my course, whatever.
Yeah. So everybody says, well, can you learn on your own? Absolutely. And the time to start is now. Whenever this is, that's fine. Even if we're in the future, as Cody loves to say, still good. It would have been great to learn 25 years ago. Second best time is right now, just like planning a trade. So I usually recommend 3 books. So Simple Path to Wealth. And then we have the Little Book of Common Sense Investing, and then the Random Walk Down Wall Street. And those 3 kind of like get a little harder as you go along. Simple Path to Wealth is easy for you to pick up. Talks about the general concept of how to gain wealth, where do you go, all that. Keep in mind, all of the financial literature assumes you have kids. So you're going to have to do a little bit of interpretation.
That's why we're here, Dr. J. That's why we're here.
Understood, but I'm quoting books and just.
Yeah, I know.
So if you find some stuff in there that doesn't fit you, you're going to have to adjust. The thing that I hear about those books is some people push back and we go, oh, those are old. Yeah, the original Little Common Sense book is decades old, but it still works. The Random Walk Down Wall Street was original a couple decades ago. It still works. And I think the challenge is people are looking for how do you reinvent the wheel on investing?
How do you outsmart the market? That's, yeah.
You don't. I mean, this is going to sound a little silly, but let me give you my take on it. So I am a certified financial planner. I have a PhD, finished my MBA. I don't try to outsmart the market. And this is what I do for a living. I'm just trying not to, because the game's rigged. Okay. The only way to win the game is to invest in everything and just go along for the ride. And that's what you'll see in a lot of the books. So if you want to pick up the books, go there. One caution on the internet is pick a recipe and stick with it. I don't care which one. If you start like taking a little bit of advice from all over the place, it's like you're making brownies and cookies at the same time. You're not going to get there.
Yeah. And that brings us to why to invest.
Yeah. So what happens, actually, let me just finish on that. That way you can also pay somebody to help you out if you want, but you don't have to. Okay. You don't. It's a matter of how you learn best. So the first thing on why is figure out your why, not mine. And that's hard. So Cody, what's your goal in investing right now?
To not lose money. I think that's the bare bones goal to get for anything.
So if your goal is to not lose money, then you're not taking a lot of risk. Is that fair?
It would be fair. Yeah. Should be fair.
So, but what are you going to do with the money in the end? Like, are you going to like take it out back and light it on fire? I mean, what's your goal?
I mean, I like for me personally, I think people just want that stability of knowing that, you don't have to be, working that 9 to 5 that you don't want to work if you don't have to, if you're able to, subsidize your income, given what your budgets are, if you're able to keep your budget relatively low, then the ceiling is lower and your floor is a little bit higher. So, to me, it's just being able to have just a peace of mind.
That's great. What's the number for the peace of mind?
We talk about this all the time. I can't really think of a number, but everyone always uses like 2 million. Let's just throw that number out there to feel good about myself. 2 million. Let's go with that.
So here's the thing. If you don't have a goal and don't have a number for investing, I don't know if I'm going to get you there. And I don't know if you're going to get there and if it's worth it.
Yeah.
Because really what we're trying to say is, what do you want to do with the money? People go, well, I want to invest. I want to make money. Cool. And then what? And that's where people just like, you and you and I both spend time in the FIRE groups, financial independence, retire early. That might be a choice retirement, which then is actually somewhat of an easy math equation. There's how many years and cover your expenses, and that's it. The other one that you hear a lot in child-free folks is what I call FILE, financial independence, live early, which is I want to do the dimmer switch work. I don't want to have to like work my butt off. I want to pick what I do, which changes, but you want to start with a goal and it's gotta be a number. Yeah. And this is where people kind of like lose their mind. You might need help to work on this. And by the way, you might move it. We talked last time about, are you saving too much or spending too much based on the goals? But this is going to determine your investing. So if I say, I want to be a millionaire, that's a common one.
Sure.
Cool. By when? 10 years, 5 years, 2 years? It doesn't matter. And what happens with money is people say, well, my goal is going to be a millionaire. I just want to like break even. I just want to have $100,000. I just want to pay my bills. That's all fine. To be frank, it's all just a matter of numbers of zeros at the end. If you're saving for $100,000 or a million or 10 million, the math is the same. It's just times 10 or times 100 or whatever else it is. So you got to get the goal because that's going to determine how much risk you can take. So let's talk about risk and reward. So if I want to be a millionaire by tomorrow, I was thinking about this when I was writing on this, and Cody gives me these topics and tells me, what about this? And I'm like, oh boy. So, okay, if I want to be a millionaire tomorrow, I got $100 in my hand. Best answer is to go down to the casino, put it on number 17 or whatever number you like, and hope it hits in a row like 12 times.
Just ride it out. Yeah.
Like it would have to like hit every single time doubling, and you'd be a millionaire tomorrow. Statistically, not going to happen.
Yeah. Going back to our disclaimer, Dr. J is not saying to go down to the roulette wheel.
No. But here's the thing. That's the way people think about investing.
Yeah.
So just this week, Warren Buffett did his annual meeting and was talking about it. He's like, the stock market's lost a little bit of its mind. And now it's Warren Buffett talking about it. He's the Oracle of Omaha. He's, I don't know, it's like $140 billion or something like that now. And he's like, look, people are gambling too much. They're not investing. So here's the way Warren Buffett says it. Warren Buffett says an investment is I buy something good of value and I hold it for a long time. That's what he sees as an investing. I happen to be kind of on that same thought. Let me buy and hold forever. But it's a matter of how much risk are you willing to take? And what's happened is the last 3 years, the stock market's been going straight up. It's great. And then life happens. What goes up must come down.
Or life stops happening, which we learned back in 2020.
Yeah, 2020 was a interesting year. We went down 20% and back up 20%, depending on how much you want to use. But
yeah,
so it was a huge, huge swing. So when you're investing, it's a question of risk and reward. So Cody, you said you're not a risky person. Is that fair?
I would almost venture to say, in general terms, I think a lot of child-free people are averse to risk. Just that's kind of a lifestyle in itself. There's a lot of chances that could happen of having kids and responsibilities, and we're kind of like, yeah, I'll pass on that. So yeah, I would say for myself, I am, a relatively safe thinking person when it comes to my investments and savings and all that stuff.
By the way, my data would not back up that child-free folks are special on the risk scale.
Okay.
As far as investing, it's kind of normal, nothing crazy either way. Because to be honest, what we do with our money is often different than our life. I got people that would skydive, but that wouldn't invest in the market, or vice versa. So it's not necessarily like what risk you're taking at home. I think what happened was over the past couple of years, you had a whole bunch of people doing the YOLO type routine of just put it all in the market, let's go and see what happens. And by the way, a lot of people made money, and a lot of people lost it all. Like probably the same amount of numbers. That is kind of how the math's going to work out. That's just how the market works out. People buy in, some people win, some people lose.
Yeah.
But what happened? So this is going to freak you out, Cody. There were a lot of people that were actually, because the stock market was doing well, took out loans on their house or their car or whatever and put it in the stock market.
Yeah, I would not do that. Would not do that.
That is an extreme level of risk.
Yeah.
You're literally mortgaging your house for a chance at investment. Right? If your goal needs to be done tomorrow, okay, maybe. But I'm not really sure what that would be. If you need $1 million for cancer treatment tomorrow, okay, maybe. That's it. And what people go is, well, I could always go bankrupt. And sure, you could. Starting over sucks. So it's a matter of how much risk you're willing to take. And we're going to talk about stocks and bonds and the balance of that. And that often balances out the risk. But you need to know how much risk you're willing to take to get to your goal. So Cody, you've been in the fire community for quite a while, and you've seen the people that give up everything now to fire early. Literally they're living in they're renting a room in a place rather than even having their own place, eating beans and rice or ramen noodles, and they're going to fire in 5 years or something along those lines. You've seen those people, right?
Yeah.
They want their goals immediately. Cool. That works if that's what you want. You need to figure it out. But here's kind of the rule I want you to think about as far as risk and reward for investing. The question is, do you want your investments to be sexy or do you want them to work? Cody, which one do you want?
I want them to work. And for me, I like the idea of not necessarily the overall goal, but what that money is able to do to work behind the scenes to provide the lifestyle that I enjoy. So let's say I need whatever, 4,000, 5,000 a month. So 60,000 a year. That's all I really need to live. I don't need a big flashy car. I don't need all the newest tech toys. 60,000 a year, I'm good. So to me, it's not so much what that big number is. It's what is it able to do for me on residuals.
Yeah. So here's the fun one on risk. Here's a test I like to use. If your investments are keeping you up at night, you're taking too much risk. And that has to do with your personal choices. Some people can take the risk. Some people can't. If you have to check the market every 20 minutes and see what your portfolio is doing, you're taking too much risk. You want your investments to be boring to you, whatever that is. My level might be different than Cody's, and that's okay. But I need to be able to sleep. The other way to look at it is they say, do you want to eat well or sleep well? Because you could take a gamble and you end up eating well, but you're not sleeping.
Yeah.
And that's a balance on this risk and reward. And you need to balance that with your goals and be realistic. If you're like, hey, I want to be a millionaire tomorrow, ain't happening.
Yeah. And so where to invest? So we've got some topics to talk about there.
Yeah. So if we follow the general rule that you only invest in things you understand, we have to understand what, where, how, and why, and where it fits in our plan. So the goals set the why. Why am I investing? Where am I going? The where is what type of accounts help me. And this one, and sorry, this is a US centric thing, is about taxes. All right. So the bottom line on taxes is you have to pay them.
Sooner or later. Now or later, you got to pay them.
You get to choose how you want to spend the money and how you want to pay the taxes and when. So we'll start with the first type of standard brokerage account is a taxable account. You'll hear that term. And here's what this means. I buy a stock, I sell it, I make money, I pay to my taxes on it right then and there. If I keep it for a year and 1 day, it's actually a year and I can sell the year and 1 day after, I pay long-term capital gains, which is a lower rate. And the lower rate, actually, long-term capital gains could be 0. If you're making under a certain threshold, you pay 0 on your capital gains tax. Most people pay about 15%, and then the top range is 20, as opposed to income taxes, which can be 38, 39 at the top. So there's differences in the percentages. Now, a couple things on the taxable account. If you have dividends, you're going to pay taxes on that now. And that's one of those things that people miss because they're like, well, I enrolled in what's called a DRIP, which is a dividend reinvestment program. So my dividends, just buy more of that stock. Yes, but to the government, you got that dividend to pay that tax. That's in a taxable account. The other one for the taxable, I have to caution people, is about day trading, right? So I had multiple people over this past year that picked up some apps. I don't care what you're trading at. Started paying. I'm a day trader. In, out, in, out, in, out. So here's what happens. The IRS has this funny rule called wash sales. And a wash sale is I sell something, I made a loss. Cool. I sell it. I get credit for that loss on my taxes. But if I buy that same stock within 30 days on either side, or a similar stock, this is where it gets a little technical on it, IRS goes, nope, that loss is gone. You can actually, by doing wash sales, owe more money than you made. I had people with 6 and 7 figure tax bills from wash sales.
Wow.
So you don't day trade. If you're going to day trade, you actually have to file with the IRS a year in advance of when you start day trading, which, by the way, most people don't think that far ahead to plan a year in advance. But you got to watch out for that. So what that means is you have to have a plan, buying and I'm selling, but I'm holding it. I'm not in, out, in, out, in, out. So besides a taxable account, let's talk about something how we can work this. So when people think about 401ks, they're usually talking about PreTax Tradition. And here's how this works. So I get my paycheck, and rather than taking the money myself, I put it into my 401k tradition. What the government says is you didn't get the money, so we're not going to tax you on that. So your income this year goes down. Here's the problem. You got to pay your taxes at some point. So they go, we're going to take that when you take it out. So let's work this together. So let's say I put in 10 grand now. I don't pay tax on it. I get a 10 grand break in my taxes. That's useful if you have to qualify for student loans or some other government assistance where you need your income to come down. But that grows to $100,000 in my retirement. Now I'm paying taxes on $100,000 rather than the $10,000. What do you think about that, Cody?
Well, and everyone's situation is different. They may want to avoid that next tax bracket, and so they say, you know what, I'm just going to put this much amount so it doesn't go into it. But as I learned before, it's a stepping stone with tax brackets, so it doesn't matter, you're paying up to that level anyway. Traditional works for some people that need to have certain tax advantages and to qualify. So you're right there. And then
Hold
the other,
here's two things on this. One, let's bring this back again. Your tax brackets, you pay for this one bracket, and when you go over it, you pay tax on what's over it. It does not change what you paid down.
What's under it? Yeah.
So this, like, I hear a lot of people, if I work overtime, I pay more tax on everything. No, you don't. You pay extra on that part that's up here. You don't change what's below it.
Once you cross that threshold of the tax level.
Yeah, and the same things would be with the traditional and 401k and all that. You're really only talking about, I'm not going to pay tax on that top part. It doesn't impact the rest in the bottom. And one other thing on this, if your employer is doing a match, like say I put in 5%, they'll put in 5%. That match right now is always going to be traditional. So that's just the way the rules work. So the next one is what you'll see as a Roth or post-tax. So here's how this one works. I get my paycheck. I pay my income taxes now. Great. Then I take that money and put it in. Well, the IRS goes, you already paid your taxes. So now when I retire, it's mine. Now, my general rule is with clients is Roth until they tell me some reason why they have to go traditional. Like they have to convince me that there's a reason they're bringing down their income that makes sense. And a lot of times what I hear is, well, I don't want to pay taxes. No, that's not a choice.
Yeah, you're going to pay taxes.
You got to pay taxes.
Ask Al Capone. You're going to pay taxes.
Right. So the Roth, the bonus is, the way they look at it and the way they phrase it is, you're paying tax on the seeds, not the harvest. So I'm just paying on that 10 grand I put in. And if it grows to 100 grand, that's mine. Now, here's the other fun one of this one. A traditional 401k comes with what's called RMDs, required minimum distributions. When you hit 72, for most people watching this, might be a little younger if you were already in RMDs, but 72 for most people, you are required to take money out of your traditional 401k. It's a math equation the IRS sets, and it changes a little every once in a while, but math equation. Well, here's what happens for a lot of people. When you don't really need it, because if you did, you would have been taking it out already. And you might get bumped into that top income tax bracket because you're being forced to take out these large chunks of money.
And a lot of people say they want to work into their 70s anyway. And so now you're working, and the government's saying, well, now you also have to go into your 401k.
Yep. Here's the difference. A Roth IRA, no RMDs. And if you have a Roth 401k, you can roll it over to a Roth IRA. No big deal. Just a piece of paperwork. No RMDs. That's a big thing. Your 72-year-old self will thank you for that now. So retirement accounts, and this is like taxable, Roth, traditional, that's like the type of tax treatment. Then we get into like a series of numbers that mean nothing to anyone. 401k, 403b, 401a, 457, blah, 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 blah. Okay. Bottom line is, if you work for an employer, they're going to probably have one of those. Nonprofits tend to have a 403b. For-profits tend to be a 401k. Doesn't really matter to you. What matters is whatever that maximum is for that account. And what happens is, like for right now, we're in 2022. I had to think about what year we're in. In a 401k, you can put, as the employee, $20,500 plus a catch-up if you're over 50 years old. And then your employer can put a match, and the total can only be $61,000 max. By the way, I really would love it if my employer put.
Yeah, no kidding.
That's a separate discussion. So most of those four numbers or a whole bunch of number things, they're very similar. What I encourage you is to look this year at your maximum, whatever the requirements are for that. Now, the other retirement account you'll hear is an IRA, an individual retirement account. And these have a little different rules. So IRAs have both a maximum you can put in, which is $6,000-ish right now. There's a catch-up option. And there's income maximums. So this is where people really get confused. A Roth IRA has an income max, and then you can't submit to it. A Roth 401k does not. And that's like one of those, they're like, but they're both Roth. Yes, but what matters is the IRA versus 401k part of it. It's not the tax part of it. And it gets really kooky as you start kind of thinking it through. There are ways, you'll hear these things at backdoor Roths and all this other fun stuff. You can do a whole bunch of fancy stuff to try to work with the IRS and work around the IRS. But what you need to think about is Okay, am I getting it from my employer? It's probably a 401k. It might be a SEP IRA. That's like you'll see those occasionally. Every once in a while, there's a pension. That's a whole different ball of wax. You don't have much control over that. And then an IRA is the type of account you put money in for yourself. Now, the money you put in a 401k is yours too. It's just a different bucket. The bonus is that you know, depending on your income, you can use both buckets.
You can use both of them, yeah.
Depending on what happens. But what's more important is the tax treatment. Is it a taxable, pre-tax, post-tax? Not what number or what type of account it's in. What do you think about that, Cody?
I mean, yeah, we're throwing a lot of alphabet soup at people. You've got, you know, this, that, the 40 this and 503s and whatever they got out there. We're about to throw some more numbers at them in alphabet soup too. But that's why we're having this talk. There's a lot to digest for people that are looking into this. If your company happens to have, let's say, a 401k plan, look into it, especially if they have a match. Take advantage of it. That is free money. Like, they're going to contribute to your retirement future. That's great. So in a lot of those cases, it's kind of set it and forget it. Just let the money come out of your check and go into it, and there you go. So yeah, you can also delve into the two bucket system, having your own as well, and that's planning even further ahead. So if you're maybe someone who has a problem saving money, that might be a good option to begin to kind of plan for the future and put money away for retirement, and kind of save, and hopefully you get a multi-return investment on that.
Yeah, and two things on that. The match from the employer, keep in mind, usually has some type of time you have to be there, like 3 years, and then the match is yours. That does not impact what you put in. That's only the match.
And if you leave the company, you can take it with you to your next plan, or a private plan or something like that as well. So don't think that, oh, well, I have to stay with this company because I have so much invested in the 401k. No, you can take it with you. It's okay.
Yep. Also, just a fun one. If you are doing gig work or doing your own small business, you can start your own 401k or IRA or other things for your business. And actually, here's the fun one. If you're running your own company, you can actually put the employee and the employer part in. So maybe you can max out that 61.
Yeah, there you go. Money. So we've got HSAs, 529s, and some other specialized accounts.
So, by the way, Cody's going to include the link on this. I've got an article written out so you can go through all this, because I don't expect anyone to memorize this stuff at all. I want to call out HSAs as special. So HSA is a health savings account. If you have a high deductible healthcare plan, which essentially means you're going to paying out of pocket, you can have an opportunity to put in towards an HSA. Now, the fun part of an HSA is it's one of the few, if not the only, triple tax benefits. You get the tax deduction on the way in, it grows tax-free, and as long as you use it for medical expenses, don't pay tax on either. And you can invest that just like any other account. Now, probably not worth changing to a high deductible plan just to get an HSA. If you have access, it's on your plan, cool. I wouldn't like, hey, I should change this plan so I get an HSA, because it essentially means you're getting less healthcare coverage. 529s, you'll see these a lot. This is, hey, I'm saving for college, and you'll see it saving for college for kids. I have some for my nephews. It is an option, but you can also use it for yourself. So if you're like, hey, I'm going to go back to school in 5 or 10 years, put money in there. Depending on your state, you actually can get state tax benefits for that. It comes out tax-free if it's used for educational purposes. And you can actually change it. So like, if me and my wife have a 529, because one of us thinks we're going back to school and one of us changed our mind, I can just give it to the other person. So it's not like it's only for me or only for her or only for my, technically I can use the one I gave for my nephews, but that would be kind of wrong. But there are other special accounts. Depending on your needs, there's all different types. There's even like a 529 for special needs people who have disabilities and things. There's all different weird accounts. All those are doing are different tax treatments.
Gotcha. And so what to invest? This is where we get into the fun stuff that people like basically go turn to Facebook to. What should I do with my monies? So we've got stocks, or as they have been called recently, stonks. What do you want to dive in with that one?
Yeah, we're not going to go about stonks. I mean, the apes are doing their own thing, and they've got some good thoughts there, but I'm not going to get into that. Now, Here's the thing on stocks. At the core, when you buy a stock, you buy one share, you own one part of a company. You might be one of a million or multi-million,
Yeah.
but you own one little sliver of that company. What that means is you then can get dividends, which is them giving you some of the profit back, or they call it capital appreciation, where the stock price is going up. Dividends, depending on how they come, actually be taxed as income tax, or they can be qualified. The capital appreciation just as the price is going up, I'm going to get my money out when I sell. The bonus of that is, hey, I don't have to pay taxes every year until I sell it. So a lot of people like capital appreciation that's going up in price. And there's actually quite a few companies now that are not giving dividends because people are realizing it's more efficient for them, for the company to use the money and for the stock price to go up. Now, when you buy a stock, the bonus there is, unless the company goes bankrupt, you have something. But if the company goes bankrupt, you got nothing. Yeah. So this is one of those cautions. So people are like, I want to put all my money on blank, which by the way, to me is the same as going to the casino, putting it all on 17. You might get, 35 or 34 to 1, whatever the roulette is. I should know that, but I don't gamble enough. Same with an individual stock, but you can get zero too. So this is when you hear people talk about, I'm buying individual stocks. I have a hot stock tip. Sure. Doesn't work.
Or you'll see that little clickbait thing pop up and it's like, this stock has gone up 10,000% in the last, 2 months. You should look into don't.
Yeah. The other fun one coming out of the stonks world is they've actually tracked some of those, people on TV showing stocks, and they've actually figured out it's almost exactly inverse. If they tell you to buy, you might as well sell. It's just silly. And we go back to Warren Buffett again. He came out, he's like, look, people are like monkeys, they're just picking stock randomly and they think they know what they're doing. They don't have a clue. It's just, the bottom line for you is, if you're like, hey, I should put it all on one, you're gambling. You just are.
And going back to what you said, also know what you're buying. Don't just buy it because you think, you see a lot of it talked about a lot on social media. It's like, oh, this is something I should invest in. Delve into the company and see what their profits are, what they're expecting for the futures, and look into that. Look into who's on the board. Because you see stocks can drop when certain people leave a board. It's like, well, this was the financial person, the wizard behind it all. Now they've left to go to another company, and the stock will just drop by 10%, 15% in one day.
Yep. And you are also, so if we go back to that Random Walk Down Wall Street book, the theory is essentially stocks just randomly go in directions, which that's about what the data says. And that any news that's out there is already priced in. So if you go, hey, I have a hot stock tip, you would have to have insider information, which is illegal, to actually beat the market on that.
Yeah, because someone might just look at the stock, or just a stock in general, and it goes up, whatever, 1/10 of a point today, and it goes down 2/10 of a point tomorrow. There's no knowledge that anyone really has to share to the masses to force that to go up and down. It's pure speculation. It's what people think it's going to be worth and what people are willing to pay for that stock today, tomorrow, and so forth and so on. So
and they might be right and they may be wrong.
Yeah.
Okay. The challenge is, if you're putting all on one, you're not diversified and your risk is all on that company. So even big names, you'll see these big names, and then all of a sudden the lawsuit will happen for somebody got hurt with something, and their stock goes poof. And you're like, wait a minute, this company's been great for 100 years, and you're like, until. And what Bill talk about diversifying. Well, to diversify in stocks, on average, you need at least 25 different stocks, but those stocks need to not be related to each other, and that's where it gets some rough math. They talk about correlations and all this fun stuff. And by the way, you can get really dorky on this stuff and really mathy. I actually, one of my MBA courses, we had to do it all by hand, and it just my brain just exploded. But you have to do all this weird math and make sure they don't go together. So what happens is, if I just pick 25 stocks randomly, the data says a chicken will do better than most stock pickers. Literally, do the research. Chickens and monkeys have won every time. And they're literally just throwing darts.
Did you play the stock market game in high school? Did they have that?
Yeah, they're all whatever. And, it's just random.
Yeah.
So what's happening is if you're going, hey, I want to buy one stock, what should I buy? My answer is don't.
Yeah.
What do you think?
If that is your retirement plan, that's a very risky plan to have because we've seen over even the last 5 years, like titans of the business world like go down. The blue chip, quote unquote, blue chip stocks, which are like solid stocks, like completely go away. So there's no guarantee that it's going to be there.
Yeah, I mean, look, if you want to take a couple bucks of your portfolio, 1 or 2, 10%, whatever, just small percentage, and take a gamble, sure. But that's a gamble. That's not part of your financial plan.
Mm-hmm.
The other thing when you're kind of looking at just individual stocks is if somebody is saying you should buy it, I always go, well, why are you saying that?
Yeah. Well, like you said before, when they're tracking who's saying to buy what, it's like, well, they're getting rid of it.
Yeah. So
next up, we've got a little bit of a safer thing. Some people might say bonds.
Yeah. So bonds are those things that we haven't talked about in years because people have been all making money on the stock market. But essentially what this says is you are loaning somebody money and taking the interest.
Mm-hmm.
So you can have corporate bonds, you can have government bonds, other things, and they're really safe and really boring. They're actually returning very low in right now. But what happens in a portfolio is if you want to like balance the risk of the stock, you can buy the bond and you're going, okay, this one's just going to be slow and steady, not making much. And I'm hoping this one takes off and I'm going to balance those two. One little weird one on this, so it's not technically, but it is a savings bond, but it's a little different, is I bonds. So
Mm-hmm.
I bonds have become real popular over the past, say, 8 months or so because they're tied to inflation. I bonds are actually offered by the Treasury, the U.S. Treasury, so they're by the government. The downside is you can only buy 10,000 per person, and you have to keep it there for a year. But the upside, they just announced, so we're in May of 2022, a couple days ago, over 9% interest that you're getting on that I bond. That's because it's tied to inflation. So there are ones that are relatively safe with a high return. But usually if a bond has a high return, it's because it's the old school junk bonds. Cody, you remember the junk bond problems of, what was it, the 80s and the early 90s?
I mean, I don't remember. I was a child, but I've heard about them.
Yeah. So also mortgage-backed securities is another one of those that 2008.
Oh, yeah. That I do know about.
Yeah. So junk bonds are people that are going, look, they're really, really high risk, so they'll give you a high interest. And you're going, I don't know if I'm going to get my money back.
Mm-hmm.
Versus the U.S. Treasuries, which are considered risk-free, unless you think the U.S. government's going up in flames, which it might. I don't know. But if it does, we got a bigger problem. And you're going to get your money back. So that's that balancing act with bonds.
Mm-hmm. Some other options are ETFs and mutual funds. What the heck is an ETF?
I'm trying to think of a random words to go with it, but actually what it is, it's an exchange-traded fund. We also hear about index funds. And what that is, for example, I can buy an ETF that is the entire U.S. stock market. And there's different ways they weight it and things. But the bottom line is it buys a little bit of everything. Well, the bonus there is if I buy the entire U.S., then I'm diversified by nature. And I can buy one share of an ETF and buy a little bit of everything.
Uh-huh.
There's also ETFs that are specific. So there's ones like technology, or there's ones like no oil, all oil, whatever you want.
Green energy, yeah, stuff like that.
There is an ETF or a mutual fund for everything.
Mm-hmm.
Now, technical things. ETFs and mutual funds. Mutual funds tend to be a higher price as far as fees. So one of the things you want to look at when you're buying an ETF or a mutual fund is the fee worth it? So usually what happens, the mutual fund tends to be more active. So they have somebody who's like, they're paying to run it. An ETF is just like a little bit of math equation for every stock.
Uh-huh.
Not a lot over it.
kind of a set it and forget it, where the mutual fund has someone watching it. It's like, okay, I should maybe dump some of this, buy some of that.
Yeah, and there are some passive mutual funds that have lower fees too. And by the way, your 401ks invested in mutual funds. You'll see this. If you're doing a traditional, taxable account, you have other options, other things. But here's what's happening. You may see what's called a load fee. Well, that's them charging a sales commission. I was looking at one recently, 5% just to get in. So that means if I invest $100, they're taking 5 of it just for the honor of me buying it.
Congratulations.
All right. That's actually technically for their marketing and all that. Then they charge 1%, 2% a year. So if I have a fund that's 5% load and 1% charge a year, that means I'm losing 6% on it by the first year.
Well, they call it points, don't they? So it doesn't sound like it's actually dealing with your money.
Well, they'll say 1% and 100 basis points and all that. It's all the same thing. Okay. I use $100 and do the math on back. Where you can get other ETFs that are literally like 3 cents for that same type of thing. So if you're going to buy something with a fee, you have to get something for it. If you like, for example, very common to see, I want this specific subsection, this little bit of just this one thing. Cool. Well, then you're getting more specific. People are going to have to manage it. You're going to have more fee. If you look at your 401k, you'll have a list of a whole bunch of mutual funds. But what you'll see is they go from 50 basis points, which is 0.5%, to 200 basis points, which is 2%, in fees for the same damn thing. It's just like different names, and this one's better.
And they have two different people, two different people are managing them, so they got to pay their salaries.
Yeah, don't pay fees, okay? It's just, active funds tend to have higher fees. If you're going to go active, they better make enough money to pay back that fee. By the way, I don't pay fees. I am that is one of those, I like ETFs, I like it, and I'm over there looking down to that last penny going, you're charging me 3 cents and this one's charging me 2. I'm down to that point.
And if someone's watching this in the future, the comment section is there. If you have a difference of opinion and want to throw your 2 cents in, or your 0.2 basis points in.
Yeah, my point is, if you're getting a fee, get something for it.
Yeah, make it worth it.
Keep going.
Yep.
There's a specific one I wanted to call out, target date funds, because these are really, really popular right now. And it's actually a pretty good answer for a lot of people. So essentially what it says is, let's say I want to retire in 2040. I don't know what that is. That's a lot of years from now, 18 years from now. It'll start with a certain mix of bonds and stocks. And then as it gets closer to 2040, it's more and more bonds and safer. It's a set it and forget it. Okay. You're going to pay a little more fees for that, but you set it and forget it. That's literally what it's for.
Yeah.
In your 401ks, you're going to see a lot of this. Target retirement date of X, and that's the funds.
When I had my first job that offered the 401k, actually it was a 403b nonprofit. That's what I saw as well. It's retire by this year, your target age range to retire, whenever you plan on retiring. So yeah, I looked into it and exactly what you said. They teeter with the numbers as it goes on, and you don't have to worry about it, kind of thing. And so yeah, that's been around for a little while, and it's a popular choice for a lot of people.
Yeah, just watch out, by the way. This one actually in a taxable account can cost you a tax bill because they keep adjusting it.
That's true.
It's better in a 401k or something like that. So let's keep moving.
Sure.
And let's talk about the weird stuff.
All right. Bring out the weirdos.
This is where the orange juice commodities work. All right. Let's say I want to buy oil. That's a commodity right now that we're in May of 2022. It's on topic of everybody. I can buy it. I can actually buy a barrel of oil and then sell it when it goes higher or lower. The problem is there are way too many factors for me to understand that. The old school was, a bushel of wheat and all this other stuff in commodities. If you understand it, if you have an insight, cool. If you're buying based on what you read in the news today,
yeah,
good luck.
If your great grandfather was a Brussels sprout farmer, and Brussels sprouts like the back of your hand, and if the weather is looking at the almanac, we'll have a great harvest of Brussels sprouts. Buy you some Brussels sprouts. For the most people, though, commodities, yeah, it's a shot in the dark.
Yep. And then the other one we get all the time now is crypto. Everybody's asking about crypto.
What's crypto? What's a crypto?
What about this coin and blockchain and blah, blah? Okay, cool. All right. My first gut on this is if it can change in price and double overnight by one tweet, I don't want to be in it. Because that tweet goes away or doesn't, I can't trust. I have no control over that.
Well, this is like the biggest like FOMO thing right now. Is like, well, crypto is depending on the one. Like it's gone up this many percentages. Again, you see that all on social media, on clickbait ads, whatever it is. Join up. You can buy it here, sell it here. And I kind of along the lines of you are saying, I don't really hear people actually using it. No one's spending their something called Bitcoin. No one's using that in their Amazon account to buy toilet paper. Nobody's doing that. I mean, I don't think anyone's doing that. But
it's starting to grow. So Cody, all right. I went on a road trip. I went down to the beach and I stopped at a gas station and they have an ATM for you to get Bitcoin. And I'm like, what am I supposed to do with this? Does it go in my taxable account? How do I account for this?
Oh no, the government, it's on your tax forms now. If you have sat down with your CPA or even done your own taxes, there's literally a line. Have you purchased any cryptocurrency in the last year? And you got to tell them like that's, you're supposed to.
Yep. I actually think blockchain technology has a great place. I don't know what we're going to end up doing with it. There's a lot of opportunities. I think crypto has some opportunities, but I don't understand it enough. Okay. And that's part of the question. And by the way, I literally spend at least an hour a week researching crypto, keep up with it. And I go, okay, I got that. Now what? Here's what I worry about. Commodities, crypto, and any type of others. Don't put your whole portfolio in that. You're essentially gambling again on roulette wheel.
Yeah. And NTFs is another one that's coming out on
NFTs. Yeah,
NFTs.
So I can own a part. Now, the idea of, hey, I have digital products, I'm going to have in games, I'm going to move. There's actually some good components there that I understand. I like video games. I understand that. The investing side of it, I go, I don't know what this is yet. There's no track record. So that's where it becomes hard. And my thing is only invest in things you understand. If you are a technology person, you understand crypto and you got it, boom.
Yeah.
If you don't have a clue and your friend said you should own XYZ coin, it's just like any other stock that they told us. So
and that's one way to look at it too. Yeah, it's just another hot tip type of thing. Kind of like what you're saying. I like the idea of like the cryptos, but being risk averse, I'm like there was an ad during the Super Bowl this last year, and it had Bernie Sanders and some other people being like, nah, I'm passing on it. That's kind of where I'm like, I don't know about that. So,
and by the way, I'm actually okay if I'm old and missed the boat on that one because I don't understand it. Okay, that's kind of my like.
We'll watch this in the future when we're all old and gray.
You idiot!
Oh, shut up! Or thank God I didn't. I mean, who's to say? Well, no. So, how to invest?
All right. So here's the thing I want you to think about. When I do reviews with people, one of the things I see all the time is I put money into my IRA and they're going, and I invest it. You didn't. Putting money into your account does not invest it in something. Now you can set it up like with your 401k and it automatically invests. But like, for example, if I put $6,000 in my IRA, it's just going to sit in an account and be $6,000.
In a cash account or whatever they call it for their.
Usually cash or money market, it's not invested.
Yeah.
Now, the other thing I see people is, well, I have an account at this brokerage and this brokerage and this brokerage for diversification. You didn't diversify anything. You just have 3 logins at different places. The bonus is a brokerage or a firm actually becomes a custodian. They don't actually you're not buying them. You buy the stock, they do the processing, they put it in your account, they're holding it for you. Now there's some technicalities around that, but that's close enough for you to get it. So the first step is you put money in. So let's just say, connect your bank, put my $5,000 in. One caution on this. If you're doing a retirement account, 529s, others, it'll actually ask you, for what year should you credit it? That's really important because there's limits. Now, we happen to be in May, but if you were in April, I would probably still be able to, before April 15th for most people, put money in my last year's account and then fund this year's. But if I don't switch that right, it becomes a problem. The other thing it says is, what are we putting this in? Are we putting it pre-tax, post-tax, taxable? And once it's in there, it's really hard to change. might be possible, but in most cases, not. So you've got to put it in the account. You have to have the right selection. Then you actually have to go buy stuff. And buying stocks, not that hard. Same with an ETF. I want, stock is at $50. I want 20 shares of it, and that's my math. The one thing you have to think about, if you want to invest 1,000, you have to do the math backwards. So if it's like stock's at $16 and I want to invest 1,000, I have to bring up my calculator and go, how many shares can I get? There are things called fractional shares that sometimes work, sometimes don't, depends on the brokerage and the stock. The bonus of an ETF is they're actually effectively buying you small sections of everything. A mutual fund, on the other hand, you can buy as $1. You say, I need $1,000 in XYZ mutual fund. Technically, that only happens after the market close, and they just buy you $1,000 worth, and you'll have like 32.6457 shares of that. So that's a little difference on mutual funds versus stocks. Not a big deal.
And sometimes there's minimums on investing as well.
Yeah. So you will see, especially in mutual funds, 3,000 minimum, 5,000. Okay, I need and that's usually an initial minimum. Then you can add more. The bonus is you can actually, if you got a good plan, you're like, hey, I like buying XYZ ETF. That's not a real one. I'm just making it up.
I'm sitting there thinking, please don't let that be a real one. It might be.
It is probably, but just a random letters of ETF. You can actually set it up so it automatically does it for you. So like each Friday when you get paid, it takes out a certain amount and does it. The same thing your 401k is doing. You're putting money in all the time. That actually is called dollar cost averaging. You're buying it over the time. You're better off that than going, all right, when's the market at the bottom? And you're not going to figure that out. Just buy it and hold it forever and it'll work itself out. But what you're doing then is you're actually doing the investing when you buy it. And that's just a technicality. The other thing is it'll take a couple days for you to actually get it in your account. Don't freak out. The other one, and this is just my random dumb luck, every time I buy something, it goes down the next day. Like
that's Murphy's Law. It's just going to happen.
So the rule is you make a good decision and then you forget about it for a while.
So follow Dr. J's advice in the future. He's going to say, everyone should buy this. Don't buy it. Buy it the day after.
So I actually worked with somebody who had the worst stock luck ever. And we got to a point where we knew whatever he bought, it was down the next week. I joke about it. It's just Murphy's Law, but you're not going to get that return immediately. And if you do, you gambled somewhere. You
shouldn't be planning on getting that return immediately, unless you're one of those day traders that we talked about. This is like a potential short term, at least a few months. Wait a little bit before you worry about selling the thing.
So I do this for a living, and for me, I actually check my own personal portfolio once a quarter and go, is my plan still working? Cool. Set it and forget it.
There you go.
I would like to look at it more often, but I'd also lose whatever hair I have left.
And so with talking about it on a consistent basis in mind, Dr. J, tell us a little bit about what you're doing with folks. Right now, it's on Fridays. The day may change in the future. Everyone should always go to childfreewealth.com for info on this, but you've got a cool group you've put together that's sharing info and talking.
Yeah, so I'm actually offering open office hours, Fridays at 10 a.m. You go to childfreewealth.com. You can actually sign up. It's limited to 12 people. And come and ask silly questions. Whatever you're like, yeah. I always wish I could ask somebody. And I'm going, I'm there.
Yeah.
I'm a singing monkey. You just tell me what to,
No judgment like this.
You pick the song, I'll sing it. I also offer no cost introductory meetings if you want to just talk to me one-on-one. 60 minutes, we kind of get to know each other. What I won't do for either of those is don't come in and go, hey, I have this great stock pick. I'm not talking about that. I actually can't. I need paperwork before I can give you specific. I'm an investment advisor, so I have to do paperwork for everything. So that is the bonus. The other thing, while we're plugging, is my new book is out, Portraits of Childfree Wealth, available for pre-order. For those of you that are on Goodreads, I'm actually running, if you're in May, I'm running a promo, 25 free copies by print, signed even. I don't know what that means, but I have to do that for the giveaway. And you can do that on Goodreads. Here's the thing on that. I talked to 26 people about their wealth, all that. The people that did well did two things. Got out of debt and maxed out their retirement plan. That's it.
Sounds pretty basic.
It wasn't like nothing fancy. Like,
yeah, there's no secret penny stock to buy and make all the multi-millions of dollars.
No, nobody was like, oh, I invested it all in such and such. No, they got out of debt and maxed out the retirement.
Yeah.
So your investing does not have to be complex to work.
And so with that, we've got our next episode, episode 13, Lucky 13, and we are going to talk about uncertain times and inflation. So that's a perfect topic to have for episode 13, I think. So we look forward to speaking with you then, Dr. J. Thank you for talking with us today. Guys, the comments are there. This will be archived on YouTube, and feel free to ask us anything. We'll get back with you with an answer. And with that being said, we'll see you next time. Bye.